Okay, ji, Assalamu alaikum. And today, I think after a very long time, we are resuming the session for accounting. Today, let's have a review what we have done before. Chapter 1 and Chapter 2 you have completed already, and there are many topics that you have already covered in Chapter 3. So, we will resume from where we left. We have discussed the purpose of journal and adjusting entries, and we have described the four types of adjusting entries. Here are the four types, and then we have explained how the principle of realization and matching relate to the adjusting entries. Then we had discussed the concept of materiality, and again, after completion by the end of this presentation and lecture, I would be doing that, preparing the adjusted trial balance, and we will describe its purpose. So, just to recall, what were the 8 steps in complete accounting cycle? First of all, you have to journalize the transaction. You have to record each and every transaction in the journal and post each journal entry to the appropriate ledger account. Then the third step is to prepare the trial balance. And the fourth step is making end of period adjustments. Fifth, now we are on the fifth step, and that is preparing an adjusted trial balance, preparing the financial statements and journalizing and posting closing entries, and prepare an after closing trial balance. So these are the 8 steps in complete accounting cycle that we have already discussed many times in the class. Accruals and deferrals, we had already discussed what are these, and what is the need of adjusting entries is because of these accruals and these deferrals. So let's have a recall. What does that mean? Accruals and deferrals, revenue is not always earned in cash as received, nor is an expense necessarily incurred as cash is disbursed. So sometimes there is a timing difference. Like, it's not necessary that you have incurred an expense but you have also paid it. So the payment is something, sometimes it's earlier, sometimes it's later. So when it's earlier, in case of your income, you get the a liability arises in that case. And if it is like, if you have given some payment in advance, then it is sort of your prepaid expenses and all that. So once the trial balance has been made, but you come to know about certain transactions that have been left in recording, what you do these adjusting entries. Fine. Okay. So next step is why there is a need for, we have already discussed that at the end of each accounting period, to make certain appropriate amounts of revenue and expenses. It's reported in the company's income statement, and these entries assign revenues to the period in which they are earned and expenses to the period in which the related goods or services. So basically, it's the realization principle and it's the matching principle, which is the basis of these adjusting entries, that you have to record the events that have occurred once you have, once you've prepared the trial balance. Now you have to make the adjustments, and these adjustments are usually made in the company on monthly basis. So you are very much familiar with the accounting cycle. Again, this is that 5 steps, that you have prepared the journal, then you have posted in the relevant ledgers, and then you have prepared the trial balance and making end of period adjustments, and now there is an adjusted trial balance. So types of adjusting entries, we have discussed the first 2 types in our previous lecture that was also online. So I hope you would recall it. We won't go into much detail in that again, just to save the time. Today we are more focus would be more on this third, accruing the unpaid expenses, and fourth, the accruing the uncollected revenue. I hope you will, it's a very comprehensive slide. slide PowerPoint presentation, and I've uploaded on your LMS also, so you can access these presentations from there. It will be saved over there, and you can have a comprehensive learning by reading all of these. I have not missed anything, just to make you people understand the things better. So the third one we will discuss today is accruing unpaid expenses. An expense may be incurred in the current accounting period even if though no cash payment will occur until a future period. What does that mean? That sometimes an expense is incurred in a certain period, but there is no cash payment, whatever I have discussed, told you before. So these accrued expenses are recording by adjusting entries made at the end of each period. The adjusting entry is recorded by debiting. So what is the treatment over here? That you will debit the appropriate expense. Okay, whatever the expenses, you will debit it appropriate expense account. For example, if you have an interest expense or you have a salary expense, and what you will credit the related liability. For example, interest payable or the salaries payable. So here is accruing unpaid expenses. Means the period has ended but still you have not paid those expenses. What you will do by the end of the period, you have to record that appropriate expense, whatever the case is, like either it's an interest expense or it's a salary expense that you have to pay to your employees, or it's your interest payable or the salaries payable. So you have to record once the expense by debiting the expense account, and at the same time what you will credit the interest payable or the salaries payable. So what you are doing, you are actually accruing the unpaid expenses. Similarly, there are certain incomes. So when this case is totally opposite to that of expenses, revenue may be earned during the current period, even though the collection of cash will not occur until a future period. So what does that mean? That you have given the services, you have, given your services to the client, but you have still not received any payment yet. What you will do, you will that unrecorded revenue for which no cash has been received requires an adjusting entry at the end of the accounting period. And whatever the accounting period, usually these are, we have already discussed that they have the end of period adjustments. You have to make adjustments by the end of every month. So these adjusting entries are made on monthly basis. So in the current case of accruing uncollected revenue, what you will do is that an adjusting entry is recorded by debiting the appropriate asset. For example, you have accounts receivable or interest receivable, like some you have uh, the debtors have occurred, you have sold the goods when you have made the sales, but you have still not received the payment, so accounts receivable becomes debited. And what will you credit? You will credit the revenue account. Either it's a service revenue earned or it's an interest earned, whatever the case is, you will credit the relevant account. So next is what's that? What is it? Why is this all like we are, recording at one time and we are adjusting, making adjustments also. So this is all because of this accrual accounting system. When there are timing differences, like between the incurrence of something and between actual payment, like whatever the cash flows, timings, and the recognition of expenses and revenue, or there is what we can say that the timing difference between expenses and the income, that's the difference because of which this all we have a rising need of doing adjusting entries. So a company may pay cash in advance of incurring certain expenses or receive cash before revenue has been earned. Likewise, it can incur certain expenses before paying any cash, or it can earn revenue before any cash is received. So this timing difference, it is because of that. These timing differences and the adjusting entries that result from them. So, what we have done actually in the four types of adjusting entries, in the first one, we have converted the assets to expenses. You remember the depreciation case we have discussed a lot about in the last session in the March. You need to revise it again. Then adjusting entries to convert liabilities to revenue. This was the second type of entry. Then adjusting entries to accrue unpaid expenses. And that was the third type. Or last today we have discussed accrue uncollected revenue from revenue being earned before cash is received. So now what we have done. So here we have adjusting entries provide links between the accounting periods. So what is that? Like sometimes, adjusting entries provide us the linkages between accounting periods related to these timing differences. Specifically, when the previous period cash outflows to the current period expenses, prior period or previous period cash inflows to the current period. And obviously, we know that the outflows relate to the expenses, the inflows relate to the revenues, and the current period expenses. Sometimes it happens that we are actually doing incurring expenses for a future period, so that adjustment is also required. And sometimes the current period revenue to future period cash inflows. So here are the fourth, types of linkages that we develop because of these accounting system that exist in accrual time. So here is the cycle of it, that there are three periods. You have a prior period, you have a current period, and then you have a future period. So, converting assets to expenses, for example, apportioning the cost of equipment, supplies, and insurance policy. So, here it is, the transaction pay cash in advance of incurring the expense creates an asset, then it is carry forward to a current period. Here we are doing type 1 adjusting entry, and transaction collects in advance of earning revenue. So above was of the expense, now here it is about the revenue. That expense creates an assets, and this liability create, and this advance earning creates the liability. So recognizes the portion of asset consumed as expense and reduces the balance of the asset account. This is the impact of this adjusting entry type 1, and this is the impact of adjusting entry type 2, that you recognize the portion earned as revenue and reduce the balance of liability account. So uh, this is the second diagram, and it discusses the accruing unpaid expenses, unpaid salaries, and then accruing uncollected revenue. So that means that it has nothing to do with the prior period, it relates to the current period as well as the future periods. So these are the adjusting entry type 3, and here is adjusting entry type 4. So whatever we have studied till now in the theory, now it is being depicted in this diagram, and very well depicted, and I hope you will revise it and connect it with the theory what we have studied and practice it. So you have to keep in mind the two important characteristics of adjusting entries. And what are these? That it's actually adjusting entry involves the recognition of either a revenue or an expense. So you need to know that there is this revenue or expenses, the changes are in these two accounts, and ultimately this will result in the changes in owner's equity. So just because owner's equity doesn't change by itself, there must be a corresponding change in either assets or liabilities. So this every adjusting entry affects both an income statement account, revenue or expense, and a balance sheet also. So we have to take into account the effects, that what accounts are being affected in this case and how we will counter it. Secondly, these adjusting entries, these are based on the concept, as I have already told you that it is based on the accrual system of accounting. So it's not based on the cash system of accounting. So making adjusting entries requires a greater understanding of accrual accounting concepts than the recording of routine business transaction. In many businesses, the adjusting process is performed by the controller or by professional who does all these adjustments. So whenever inshallah you will be hired as accountants and professional controllers, you have to perform these adjusting entries in order to cater these adjustments. So again, it's again a very detailed thing. Then you have the concept of depreciation, and I will record it in some other video, in the upcoming video, so that you may know it as a separate concept. So the next concept, that is the concept of depreciation, I will be discussing in the upcoming lecture.